Hello and welcome to Portfolio Matters. In today's Share Talk, we will be discussing the small UK listed mining investment and royalty company Metal Tiger. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Okay, this is the third of our series of share talks on UK listed mining royalty companies. The first one we covered was Anglo Pacific Group, and then we covered Altus, and now we are doing Metal Tiger, and I intend to get on to Trident Royalties in due course. Metal Tiger is London listed, and it has a mixture of active and passive investments and claims to be a hybrid private equity style investor and an investor in publicly listed companies. And this is the share price, which has in recent years been going nowhere. And you'll notice that the share price has not really participated in the recent metals rally. Okay, so this analysis took me a very long time, and I rather got lost in the details. And actually, my conclusion is quite simple. I don't think the business model works. In particular, the costs of running a publicly listed company of about £2.7 million a year annualized as of the last interims is just too much for a company with assets under management of around 27 million. So 10% a year. So I just think this company is too small for its cost base. And so if you think about it, in 5 years' time, you know, if you're running 10% cost per annum, you've got the cost of about 50% of the value of the company. I just don't think it works. Now, there is upside potential here, and we will go into it. And the upside potential is from the royalty streams. But the royalty streams, the ones that are valuable and where there's serious upside, they are a long way off. I mean, you're still at the exploration stage of these developments. So if they come through, they could be big, but that's a big if. So let's get into it. So the company itself, and quite quickly described, as of the 30th of June 2020, an NAV of about 23 million. More recently, that's about 28 million, I reckon. With its biggest holding is in Sandfire Resources, an Australian copper company. And the Sandfire Resources share price has been quite strong, so that's increased the value of the underlying assets. Its market cap is currently about 32 million. And running costs as of June 2020 were 2.7. So you can see that running costs are very substantial for the size of the assets. And its biggest investment is in Sandfire Resources, which it has been selling down. Now, I have been through every RNS since the June 2020 corporate presentation, and very tedious it was too. And they have been busy. I mean, this is all their investments. And you can see they've been doing lots of placements in publicly listed companies. And so these are generally purchases in placings in which they get shares and warrants. And they're certainly doing a lot of them. But I mean, I question whether that is sufficient added value to justify essentially management costs of 10% per annum. I just, you know, you can buy these shares yourself. And 10% annual running costs. I just don't think investing in public markets can justify those costs, basically. So you see that since May 2020, they've done a lot of deals. They're active. And if you look at their RNS feed, you're constantly getting updates about them buying stakes in small Toronto or Australian miners. And almost all of these investments are in early stage companies before they have the project up and running. So these are the holdings in which they have a substantial stake in the company. So these are their active investments where they're involved in the management. So Cobre, they've got 20%, Southern Gold, Thor Mining, these are all big stakes where they claim to be active managers. And if you add those up, they're worth about 5 million. These are their passive holdings where they have a small stake and they don't get involved in the running of the company. And you can see the biggest one by far is in Sandfire Resources, which is almost worth 20 million. If you add all that up, it comes to 23 million, and total, including their active, is 28 million. So, and I have been through and priced every single one of these. And these are the warrants. And frankly, you know, when you look at the price of the warrants, is this really worth doing? It's like 276 grand. You went through the details of every warrant, basically. They generally, when they take part in a placing, you generally get one warrant for every 2 shares purchased, and the warrant lasts 2 years. Okay, but the upside is in the royalties, and they have 3 royalty arrangements. The first one is with the Sandfire Resources over the T3 project in the Kalahari. These are all very closely related in space. So these are all relate to the same area of the Kalahari copper belt in Botswana, and I will take you through this. So the nearest one to completion, to fruition, is the Sandfire Resources T3 project, and that is capped at $2 million. But the T3 project is scheduled for first production in the next 2 or 3 years. Now, they have an uncapped 2% mining royalty over other Sandfire Resources developments in the same copper belt, and they have a 2% uncapped royalty on the Kalahari Metals development of the same copper belt. Okay, so let's take a look at those. Now, this is from the Sandfire Resources website, and a few things to take away. So in the northeast area of the copper belt, that is owned by Cupric Canyon, which is a private company, and they are developing a mine there, and we will go into that. The T3 project owned by Sandfire is here, and there are others such as the A4 and T1 where they are drilling and getting good results. And if those were to be developed, Metal Tiger would get uncapped royalties on those assets. And this is from the Metal Tiger website and shows the exploration areas over which Metal Tiger have a royalty agreement with Sandfire, and that is the burgundy colored areas. So T3, they have a royalty agreement capped at 2 million. A4 and T1, they have an uncapped royalty of 2% were they to be developed. And this is also from the Metal Tiger website, and it's the royalty areas with Kalahari Metals. And you can see, so this is the area owned by Cupric Canyon where they're developing their mine. This is the T3 mine, which Sandfire Resources is developing. And then these areas bordered by the dashed lines are areas in which Kalahari Metals are exploring. And if Kalahari Metals were to develop a mine, then Metal Tiger get 2% royalty. Okay, so how big is the potential? Well, we can look at the Kuprick Canyon development at the eastern end, sorry, that should be the eastern end of the Kalahari Copper Belt. And these are the details from the Khoemacau, I hope I pronounced that correctly, website. And Khoemacau are the developer, and that is 88% owned by Kuprick Canyon. Okay, now the important points to know are that this is a deep mine. You're having to go, it's not open pit. You're having to go down into the earth, but it's big. This is the life of mine, so it's a big resource. It will be going for 20 years, and it will be mined with automated mining machines. And it's got a good copper grade of 2% and silver. And this is what the development is going to look like. You're cutting away the earth to get to the point where you go underground. If you look bottom right here, this is the copper seam, and it runs down into the earth. So they've designed a mine in which you have these 3 parallel box cuts, and then you go down underground, and then you start mining down into the earth. And this is what it looks like. So you're cutting away the earth, and then that is the start of the mine. And you have these autonomous mining machines which will cut away underground. There's good transport available, and then there's a processing plant and a big tailings storage facility. So if they can get the mines developed, then there's no reason why they shouldn't have hopefully something like similar economics to that enjoyed by Kuprick Canyon. And the Kuprick Canyon development is going to cost 450 million, all-in sustaining costs of 1.47, sorry, all-in sustaining costs of $1.67 a pound, current copper price 4.1. So the economics look very good, frankly, and it's going to be big. You know, initial phase, 60,000 tons per annum, rising to 150 possibly, starting this year. So let's do a rough royalty calculation on the Sandfire T3 development. And these numbers are from their website. They're aiming to produce 30,000 tons per annum and 1.2 million ounces of silver, rising to essentially 40,000 tons per annum of copper. Now, bear in mind that the Metal Tiger's royalty is capped at $2 million. And essentially, you quickly come to the conclusion that their royalty would be greater than $2 million. So from the T3 development, they're going to get $2 million, possibly in 2 to 3 years' time. Let's assume that either Kalahari Metals or Sandfire Resources develops one other mine in the Kalahari Copper Belt. If you think that the Khoemacau copper mine, the initial production is 60,000 tons per annum with 2 million ounces of silver. If we assume that, and copper at $3.50 a pound and silver at 25, you get to very substantial royalties. Royalties of 8.8 million a year. If they expand it to 150,000 tons of copper and 6 million ounces of silver, which is what Khoemacau are guiding to in their expansion, then you get big numbers. very big numbers. You're talking about royalties of 21 million a year from that mine. And bear in mind, the Metal Tiger's current market cap is 32 million. So your annual income from that mine would be enormous. But this is all ifs. You're saying currently they're just exploring. The only mine that you know is going to be developed will produce 2 million. So the T3 project, when it's up and running in 2 or 3 years' time, Metal Tiger should receive 2 million a year. If and when Sandfire Resources or Kalahari Metals develop another mine, then there's potentially very large upside, but you've got no idea when that is. Okay, so these are the results, and essentially it's tiny. You know, this is it's got big costs, and its actual revenue is small. So positives. Okay, this is a very active management. They're, you know, making lots of investments in publicly listed companies. It's a very transparent portfolio. I mean, part of the reason I spent so much time digging around in it is because I could. They publish, you know, all their warrants, all their investments, and you can go and value all their instruments essentially, apart from the royalties, which are all in the future. And as we've seen, there is plenty of potential upside from the Kalahari Copper Belt developments. But the negatives, the trouble is that its costs are just too high. Its annualized operating costs are 2.7 million. And frankly, that's down from previous years. For a company with assets now 28 million, most of which is overwhelmingly in public listed companies. So another way of looking at this would be look at it was an investment trust with assets under management of 28 million and costs of 2.7. I mean, ludicrous. That's just too much. You know, you think of an ETF which would have management fees of what, 1.5% at most. You know, an index fund of 0.2, 0.5. So, you know, fees of 10% are just too much, basically. And it trades at a slight premium to NAV. I mean, the premium to NAV has come down as the value of the assets has risen, and the share price, frankly, has drifted off. And all the upside, to my mind, is in the royalties, but they are highly uncertain, whereas the costs are very certain and are coming out every year. And as a result of that, this is the share prices of the 4 listed UK mining investment and mining royalty companies that I'm aware of. So the biggest one is Anglo Pacific, which we have covered, and I urge you all to go and have a look at our share talk on that, because we were positive, particularly after it has recently purchased a cobalt stream, and I frankly own a lot of the shares. Trident Royalty I will be getting onto, I've not covered yet. Altus I also own the shares of, and we have covered, and we liked the company but thought the share price, which has shot up over the course of the last year, may have got ahead of itself. But the bottom line is Altus do the hard work. Altus do a lot of exploration in Africa, find mines, find resources, and then aim to develop them with the help of joint venture partners. Metal Tiger right down the bottom here, and they just invest in publicly listed companies. So they're not doing the hard work that Altus are doing. And I just question the cost structure, essentially. So bottom line is, I think the costs are too high. There's upside here, but it's speculative and many years off. In the meantime, you're going to be spending 10% of assets under management every year in costs. Richard, what are your thoughts?
Thank you very much for that interesting presentation, Keith. royalty stream that you believe they will probably get the £2 million a year once the
Dollars.
a year once the mine is open, the T3 mine is open, is sort of underpins a valuation of maybe £20 million, market cap of £20 million. Presumably they're on the assumption it does open, plus of course they're holdings in the public companies.
Mm-hmm.
The question is, where does it have an upside, and if so, how big is it, and when is it, and what does the share price do between now and then? So, in your view, how far out is production on these potential mines that they have the uncapped royalties for?
Long way. They're in the exploration stage. You're talking about from exploration to development, 7 years?
Yeah. So it's a very long shot, isn't it? And in that time, it's you're sitting there hoping that other people will think that there is value in a prospective mine that will ensure that your investment either doesn't go down or goes up. And it seems to me that probably the timing, if you're interested in the resources that they have access to, you may well keep an eye on it and check the price every so often and check the news reports.
Yeah,
until such time as there's something concrete in there.
That would be absolutely my strategy, Richard. Because in the meantime, the operating costs are just eating away.
Yeah.
So whenever we do a less than enthusiastic share talk, we get a lot of negative feedback. So if you disagree with us, we are very open to changing our minds if you can provide evidence that we're wrong. So please, if you think we're wrong, send us what you have. We'll have a look at it. And if we're wrong, we'll change our minds.
Yeah. And please don't just insult us for being stupid or not having done our homework or whatever. We do our best, and we are trying to be genuinely helpful. So please appreciate the effort we put in, and by all means, constructive criticism is very welcome.
Absolutely. And as you've seen for Colonial Coal, if we get information that makes us change our minds, we change our minds. Anyway,
actually, I should also say with SolGold, we changed our minds after we reviewed the Crux Metals report.
Yes.
And since that time, the price of SolGold has actually halved. Now, I'm not saying that's anything to do with us, but it just shows these exploration companies with potentially valuable assets are incredibly volatile.
Yeah.
You do have to be very careful with them.
Absolutely. Okay, well, thank you all for listening. I'm sorry that we weren't more positive on Metal Tiger. In the meantime, please can you subscribe and press like, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.